Hello and welcome to the Gold, Goats, and Guns Market Report for today, the 30th of July, 2023. My name is Tom Luongo, and we have a lot to talk about. It is Sunday. We have new patrons. We have stuff to do, and we should get started because I'm a little late getting this out the door this morning because, well, it is what it is. All right, let's get started. So let's talk about what happened on Friday with the Bank of Japan. I wrote a big morning munchings yesterday, kind of going over this a little bit. So I guess I get to take another victory lap telling everybody that I expected the Bank of Japan to end yield curve control sometime this summer. Here we are. It's the end of July, the July meeting. So, basically in a row, on Wednesday we had the Fed, on Thursday we had the ECB, and on Friday we had the Bank of Japan. So the big clarification here is the following. I mean, it's kind of like I said yesterday in the morning munchings. It's kind of like we have Schrodinger's yield curve equation policy, yield curve control policy, right? Is it 0.5%? Is it 1%? Is it alive? Is it dead? Is it in the box? Is it even, is it even in this universe? We don't know. What it means is that no longer is the Bank of Japan giving us policy certainty relative to where they will intervene in the markets. And that is an historic shift. That hasn't been, we've had policy certainty from the Bank of Japan. They, for years, as long as I can remember. They make moves. They don't leave the markets in a state of uncertainty like Ueda just did on Friday. So we have a tweak to the yield curve control policy. The hard limit is now 1%, no longer 0.5%. But, they reserve the right to intervene wherever they want between 0.5 and 1%. Okay. Is it a cap or isn't it a cap? Again, if you want to create if you want to, I think the word I'm trying to get at here is this is a weird, it's a little odd. Confidence is a big deal in central banking. Credibility is an immense thing. Powell had zero credibility last February when he started raising rates. Zero, none, odds, right? We had 2019 where he pivoted. We had, COVID. We had all of this data which told us that Powell was going to pivot at the first sign of trouble, right? And I argued strenuously that, 2019, the conditions in 2019 were different than the conditions in 2020, which are different than the conditions in 2022, blah, 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 right? And for those of you who've been here long enough, you know that I was making these arguments then, right? I was saying, every time someone brings up, well, Powell, pivoted in 2019, so he'll do it again. I'm like, well, no, not necessarily. Why? Because you're a moron. No, because, my Twitter feed is because you're a moron. In reality, it's because the conditions in 2019 and the transition away from LIBOR to SOFR, the secured overnight funding rate, was still in its infancy, right? That process hadn't fully formed yet. And so, the decoupling of the U.S. and European financial markets was just getting started. So, of course, you can almost look at that as the inciting incident, right? Or the end of Act One, that the implementation of SOFR and, bringing on John Williams at the New York Fed in order to do this, right? In order to implement SOFR was the inciting incident. Then we get to the end of Act One. We have the repo crisis of 2019, or the pivot in January, and then the repo crisis in 2019 in September of that year, and then COVID is your midpoint turn, and then, or is it? I don't know. And then, we have the big midpoint turn, as far as I'm concerned, on June 16, 2021, when Powell starts stealth tightening by raising the reverse repo payout rate. So, and at each step along this way, I've tried to explain that conditions are different. And because underlying conditions are different, you could expect different behavior. And you may even wind up with behavior that is outside of your frame of reference, which is exactly what we've seen, right? So now I'm going to bring it back to Ueda and the Bank of Japan. So again, this time last year, Powell starts raising rates. He has zero credibility. The Bank of Japan has never had any credibility with the markets, right? It's always been seen as some amalgam of a second-class citizen to the Federal Reserve doing whatever the Fed wanted it to do. And that is true as it goes, especially because, politically, if Japan steps out of line, then the United States has beaten them back into line over the years. They have been a linchpin of the entire coordinated central bank policy era under Yellen and Bernanke at the Fed, and Draghi at the ECB, and Lagarde at the ECB, and Kuroda and Bank of Japan, and the various people who've been in charge of the Bank of England, right? Mark Carney and everybody else, right? So here's Ueda trying to begin the process of gaining the much needed credibility that the Bank of Japan is going to need if Japan is going to navigate its way out of its current situation. Now, we have members of the community who know Japan very well. I've referenced this before, and have a very strong thesis as to why they think Japan is in better shape than a lot of people outside of the mainstream, or in the mainstream, believe. And I'm not here to argue that point, the points that have been made. And because of this, we should expect the unexpected from the Bank of Japan, but we should also expect very slow, gradual shift in policy in order to begin the process of them gaining credibility with the markets. Again, Powell had zero credibility in February of 2022 when he started raising rates. He had to raise rates quickly and aggressively in order to gain that credibility. And it took him a year. At the Fed. Over the course of that year, he has, of course, exposed Christine Lagarde at the ECB as having zero credibility. So those roles have been flipped. So now you've got the BOJ. And the BOJ is trying to change its stripes. So you should expect what we've seen. Ueda comes in late April, doesn't really change anything, reinforces the idea that we're not doing anything tomorrow about yield curve control, allays the market's fears that they're going to do anything drastic, comes in, statements keep getting made to that effect, subtly all throughout the summer at every policy meeting. And now we get to the end of July and we're tweaking. And then all of a sudden we're tweaking yield curve control. We're not getting rid of it. We're just tweaking it. We're not, we haven't really changed anything per se. But the markets finally said, oh, they are serious. They're not going to. And the market tested the Bank of Japan immediately on Friday by sending the Japanese 10-year through the 50 basis point mark. Bank of Japan didn't step in. Now, we didn't get a massive, weird cross bond market currency effect throughout the entirety of the world. Because of this was just a test. This was just some Momo monkeys, my term for, momentum trading day traders, or however you want to, just momentum position traders, right? Momo monkeys chasing that Momo baby, right? Been watching a lot of The Wire, so I'm trying not to talk like the guys from the streets of Baltimore. Because those are career-ending moments if I do it wrong, and but the basic idea here is that they tested the market. They tested Ueda on Friday. Oh look, that cap's gone, and they've been trading against the unwind of short JGB carry trades in anticipation of the Bank of Japan doing exactly this. This is why, no one's been testing the cap. They've been actually trying to cover their short Japanese government bond positions in anticipation of the cap going away. So that when the cap finally went away, they wouldn't be caught swimming naked and, having to flip and cover and unwind a whole bunch of stuff and have everything be really disorderly. So from that perspective, you could say that Ueda has done his job very well to tweak and begin the process of fundamentally changing Japanese monetary policy for the first time in 30 years, away from quantitative easing, towards something different, and did so without huge fireworks. Pretty impressive. Now, he's got Powell at his back, and he's continuing to put Lagarde into an even tighter and smaller box, which I think is the plan. So this was the most significant thing of the week, without a doubt. And I'm not here, again, I'm not here to, bust in my hand, pat myself on the back or anything. This was not a hard call to make. Okay? Again, Kuroda, on his way out the door in December, told everybody what the plan was going to be. I didn't anticipate Kuroda doing that back in December, but when it happened, I immediately understood what it was and what it meant, right? We don't all predict, we're not in this business necessarily to always predict what's going to happen next. I know a lot of people try to do this, but, what you can do is analyze the events in real time as they come up and hopefully see them for what they are. And then when you see the actual change, then you know what's going to happen. Then you can, then you can make some reasonable predictions about what's going to happen next, right? So had the Bank of Japan really been on my radar previous to December of 2022, which it wasn't, I'll freely admit, I might have been able to say, yeah, at some point the Japanese are going to have to lift yield curve control. The minute it happened, I was like, of course. They're dealing with inflation. Mrs. Watanabe is, going to stop buying Japanese government bonds and start looking for yield somewhere else and blah, 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 blah. It wasn't a difficult thing to put together. All right, it's not a difficult call to make, to be honest with you, if you follow this stuff at all with, even a, passing curiosity, which, on many of these subjects I have until the moment comes when they become the focus of everything, because they are going to be the big change. So like talking about what NATO is going to do at Vilnius, or, going back to 2017 and talking about, or 2015, talking about, Russia about ready to move into Syria, and then the effects of the fight at the Coeris Air Force Base. And, like all this stuff, like these are the moments in history when you look, when you see. Our goal here is as much as anything else is to recognize these major moments in history for what they are, and then spin out your best set of probabilities as to what they actually mean, right? So the note about Pakistan comes directly from, my good friend Vince Lanchi, who, unearthed that Pakistan is now going to open up a physical gold exchange. Okay. In effect, physical gold exchanges are going to pop up all over Asia. Why? Because they're going to use gold as a trade settlement currency for Pan-Asian trade, exactly as Vince and I have been talking about for over a year now. Okay. We had a big summit up in Moscow where a whole bunch of African leaders showed up to Moscow to back Vladimir Putin's play against the West. Niger just staged a coup against the, French-backed government there. Oops. As somebody pointed out to me on Twitter this morning, Niger's one of the biggest producers of uranium and exporting it to France. So all of a sudden now that CFA franc arrangement in order to get France cheap energy to keep the lights on. Interesting. That changes. France's cost of capital for energy is going to rise because Everything's going to change. That money that gets, that uranium that they sell is going to, if Niger's correct and it sets things up properly, the money's going to stay in Niger. It's not going to go back to France. France is losing its colonies. Everybody is tired of being harangued and shit on by a bunch of European colonialists. And this is important. And this is including Europeans. So just to remind all the Europeans in the audience, we're talking about the European leadership here. We're talking about the people who have enslaved you in their ridiculous plans. And as much as we talk about the evil of, America, well, we're not talking about, Americans haven't really benefited from us. We have to a certain extent, right? But it's a Faustian bargain. Sure. Our leaders have set up these, extractive, mercantilist, colonialist, pick your ist system in order to bring cheap goods into the country and keep inflation under control and have you live beyond your means and subsidize all manner of, ridiculous thinking. Like, I don't actually have to work for a living and I don't have to produce and we don't have to bear children and we can preserve our culture and our identity. Like, are you kidding? Like, okay. But eventually that, wears itself out, right? That eventually runs out of runway. To paraphrase Margaret Thatcher, eventually you run out of other people's money. So, we've all benefited from this to a certain degree and to a certain extent. But at the same time, it's a Faustian bargain and we get one thing, but we get these things that we don't necessarily want, but we change the values of the society to the point where that's where we think that's what we want because that's all we would normally get: cheap Chinese goods, the consumer economy, blah 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 blah. When what we really want is stable communities, stable prices, the ability to raise a family without crime, blah 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 blah. All the things that civilization, the basics, like a little bit of predictability in this life, which we're not allowed to have. Because we're not allowed to have nice things. We're allowed to have cheap things that keep us pacified, but we're not allowed to have nice things that give us strength. This is kind of the point I'm getting at here. So they give us cheap things to pacify us as opposed to, allowing us to build and hold on to real things that give us strength, right? Nice things that give us strength. Culture, community, family, all that stuff. So what's happened to the United States is no different than what's happened to Europe, and the comeuppance is coming. And everybody else, including us, including their population, are tired of these people, which is why Mitch McConnell froze up in mid-sentence the other day. Maybe he had a stroke. Maybe he didn't. Maybe he realized, oh my God, it is better now to just shut up. And if I hold it in, I won't fart in public. I'm hoping I'm right about that. I really am. Hoping I'm right about that. Because these people all need to go away. It's all time for this stand. And we're going to find out real soon whether they will or they won't. And again, it gets down to, I know a lot of you are very black-pilled because you've watched them get away with murder, literally, for years. And they're continuing to get away with murder every day as we see more and more bodies dropping and all the rest of it. My point about this, however, is that it's also a very, very clear moment in time where there are changes happening. Okay. There are manila folders dropping all over the Hill right now. There are text threads blowing up as to, oh my God, what am I going to do? It's clear that, they're coming for me next. Do I turn? There's going to, like, all these staffers that, run around for years protecting people like McConnell and, Biden and Romney and all the rest of them have been in on it and loyal to them. At some point, they're all going to turn. Like, every goddamn one of them. Like, because it's their incentives are going to flip from positive to negative. And every one of these people has a finely tuned sense of when those incentives flip from positive to negative. Okay? And It's a slow process, and then it happens all at once. Once one person stands up and has the strength to say, you know what? Nope. I'm flipping on my boss. Really? You're flipping on Mitch? Oh, that's it. I'm out. Because everybody's thinking the same thing and just waiting for the one person to stand up and take the lead, and then everybody else follows. Okay? And that's why the old adage, how did you go broke slowly and then all at once, is a thing. It's all through our society this way. Okay? This is just natural, normal, everyday human behavior. So it takes time for this to build to critical mass, and then it explodes all at once. And I think we're in the building, smoldering phase of this. And if you're going to take a shot at these people, you've got to take your shot and you can't miss. You only get one real opportunity here. So if you're going after Biden and you're going after Obama, who's really the king, you got to do it right. I mean, in terms of U.S. policy, setting U.S. policy for Davos here in the United States, all roads lead to Obama, right? So, all right. And then with that, we're dealing with the shifts in the bond market. So let's get out, thanks to Ueda and all of this stuff. So let's get to the charts. I'll get you out of here. All right. We're coming up on the end of the month, so tomorrow is the last trading day of July, so we should have a good idea, relatively speaking. I mean, things could blow up tomorrow, and then Wednesday's market report could undo everything I'm going to talk about today. I've got both weekly and monthly charts for everybody to show you what we're looking at. So gold was rejected at 1980 last week, and then again this week. And why is 1980 important? Well, it's really simple. Here's last month's high, 1983.52. Last month was a 2-bar reversal off of this uptrend. So we closed below the low. We closed below the last low in the uptrend. That means we've got a new downtrend in place, because that's an actual technical reversal signal. Now the question is, were we going to see that reversal reversed? And if we close tomorrow above 1983.52, I can read. No, really, reading is fun for mentals. But 1983.52, then we can say that we've had a 2-bar reversal of this uptrend and then a 1-bar reversal of this downtrend. And if that's the case, then we're setting up for a very interesting rally for gold later this year. If we don't get that in July, then August will have to be the potential for a reversal signal in gold. And again, the level will still be 1983.52, the June high, but it'll be a 2-bar reversal, not a 1-bar reversal. It took 2 bars to reverse the trend as opposed to 1 bar. And 2-bar reversals aren't as strong a statement as 1-bar reversals. It's that simple. And 3-bar reversals are not reversals. Okay? If it takes 3 bars to reverse a trend, that's a bottom forming or a top forming. It's not it confers no net advantage. They generally are coin flips. Okay? So this is important. So this is an example of what happens when you get rejected on the weekly chart and then it propagates through the week, how it affects things when you move farther out in time. Okay? It's stifling the potential for a 1-bar reversal this month. Unless, of course, we have a big move in the price of gold tomorrow, at which point we will have the 1-bar reversal and, we're off to the races. Katie bar the door, haven't, invoke cliches. Okay, moving on. Silver. We had a big short squeeze in silver. We closed 2 weeks ago. We closed well above these highs in here, which was great. Just moving to these highs and getting rejected there would have been really good, but this is just outstanding. All right, from a technical perspective. So what have we done? We've taken 2 weeks and we've come back and we've retested these previous highs in here. We ran into resistance up in this area, and from these tails here, great, that's fine. And then we've pulled back, and now we're retesting this area here. Perfect, makes perfect sense. All right, so that's the weekly chart in silver. How does that propagate? Well, it propagates like this. We are like gold. Here's your uptrend. There's your 2-bar reversal. There's your 2-bar reversal. Right, so we 4-bar uptrend, 2-bar reversal, close below the last up bar in the trend. Against it, we close below the low. And then within 2 bars, we reverse this bar. There's the high, So now we have a 2-bar uptrend that closed above the high of the last bar in the downtrend. So that reversal's there. And then we immediately get another reversal here. Look at silver's monthly chart. It is nothing but a series of reversals and counter reversals. So trend, reversal, reversal, reversal. And here we are on Friday, one day before the end of the month. Silver got pushed back 9 cents below on the close, or 10 cents below the close. That would have created a 1-bar reversal for this month. While the rest of the commodity sector is breaking out to the upside. This is aberrant behavior. This is somebody trying to hold the price of silver down. And I'm actually more interested in what happens with silver tomorrow than gold, because this is a very high probability event that we'll get a 9-cent move tomorrow and we'll close above 24.54, and we'll get the 1 month reversal. We'll get the 1-bar reversal on the monthly chart in silver, setting up a really good Q3, because then you're going to see more, once that happens, like monthly based traders are going to step in and cover their shorts and blah, 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 blah. And it's all going to just happen. And then you're going to get off to the races. So I could get into, options, futures expiration and all this other stuff. It's all trader speak. It's not important. What matters is what happens on the close here. Okay. If we get a close tomorrow on the cash chart in silver above 24.55 or higher, that's a 1-bar reversal on the monthly chart, setting up a very strong move opportunity for silver to move back to 26 in August. Yay. Done. Nice and simple. All right, moving on. Bitcoin. And we're going to, all right, Bitcoin. Continue to get degradation of Bitcoin after running into resistance at 31,000. It's beginning to pick up steam to the downside. You can feel that, the highs are getting lower and the lows are getting lower faster. Not great, but here's the reverse of the situation. Here's your downtrend in the monthly chart in Bitcoin. There's your reversal signal. Emphatic, because it reversed all of this, not just this bar, but it reversed all 4 of these bars. We got a nice big move back up to here, 31, and now we've meandered sideways. And last month, which was June, we had a bullish engulfing bar of these 2 low volatility bars in Bitcoin. That's a good sign. An engulfing bar is where you break both the previous high and the previous low. And it's bullish because we closed up as opposed to down, and we engulfed a bearish bar from the month before, which was nearly a reversal signal of this one. I think this is not a reversal signal. I have to actually look at the numbers. Hard to tell from just looking at the chart here. You'd have to actually go in. I do believe that this is not a reversal signal. And then we got follow-through action back to the new high, right? Boom. And now all of these weeks in here is just this. So all of this is that. This bar is still very dominant. Bitcoin's still in a bull market. It's just taking a breather. Moving on. Brent crude. So, see the green line? This is Davos's line in the sand. I should have drawn it in red just to make the metaphor abundantly clear, but we have a lot of red on the page, so it would have gotten washed out. Okay. Change the color scheme. I can use red lines, right? So, and it's, approximate. So between $85 and $87 a barrel, Davos has been coming in and crushing, that includes the Biden administration, have been crushing the price of oil. They got it down into this range here for most of the first half of 2023 on recession fears and all this nonsense, and just manipulating and changing the definition of the Brent crude contract and all sorts of stuff. All this stuff that we've talked about many, many times, right? Boom. This is your downtrend. Here's a failed reversal signal because we broke this high, but we didn't close above it. So it's a failed reversal signal, setting up these weird bars in here. Like, look at this freaking thing. This reverses, then we get this, then we open here, then we close here, we open here, and then we close down here. Like, it's just unbelievably odd behavior. And it's clearly a massive fight between oil producers and oil consumers and politicians to try and keep the price of oil down here in the 70s, and eventually that failed. So here's your downtrend, even though there's no reversal signal here to deal with, but you could almost make the argument this is all one big downtrend, but it's really not. It's a bad argument. Just look at this as it is. And this is just a 2-bar reversal of this bar. And then we're off to the races, a whole bunch of short covering, including more short covering this week as we move back towards 86. The one thing I didn't show in that I wanted to show, which was the collapse of the Brent WTI spread. It's down under $4. We talked about it yesterday. I think I might have even linked it in. I didn't link it in the Morning Munchings I did yesterday, but I didn't mention it, right? A couple of weeks ago, we were looking at $5. Now we're looking at under $4. That means that domestic demand for oil and is rising rapidly and exports are falling, right? So imports are rising. U.S. oil imports are rising. Production is flat. Exports are falling. Conclusion, we're burning a lot more oil in the United States. And now it's having upward pressure on prices. So maybe right now the U.S. is the marginal producer of is the producer of the marginal barrel of oil coming out of the Permian Basin. For how long? Well, that's a good question. We'll see what happens when the Russians are, ready to pull another 1 million barrels off the market. Now let's see who's actually in control of the market at that point. Then turning around and all of this stuff. So here's your monthly chart of the price of oil, and you can see when the suppression scheme went into effect. Blah, this is all froth from the beginning of the war in Ukraine, and then this is the real suppression scheme. And I complained bitterly about this as it was going on. I talked about it endlessly on a week-to-week basis. And then here's your downtrend. It's ugly. It makes no sense. It's clearly been manipulated to the downside. And then boom. This is now a 2-bar reversal. This is a big friggin' thing. And I don't see, let me put it this way. You'll know that they still think that they can control the price of oil if tomorrow we close below the high of this bar. Even if it's by a penny, they will come in. And if they're trying and bomb the price of oil by $2.50 tomorrow, you'll know just how desperate they are to keep this in the box. And all you're doing is you're like trying to continue to compress on a spring. And, and after a while, you're not doing isometric exercises. Your whole life depends upon keeping the spring compressed. That's where they are. And energy just keeps building up inside the spring. And eventually your arms get tired and the spring pops. Personally, I think that has already happened, but we have one more day until we get the close. And I'm going to stand here and keep banging my shoe on the table like Khrushchev saying, closes matter. I have done dozens of market reports over the last 6 years where I have been like, we've got it, and tomorrow it doesn't matter. And boom, the next day they come in and bomb the fucking markets and everything just fucking changes overnight. I've seen them do it. I've seen them make monkeys out of so many people so many times. I don't buy a thing until I get the close. Closes matter. They matter more than you could possibly imagine if you've never looked at or traded markets. But it's all right here. And this is why I say to the community, even if you're not interested in this stuff, get interested in it because it's really interesting. And it's really helpful for you to see the way this stuff works. And it'll just make so much sense, and the world will make so much sense to you. You'll be able to walk in on a daily basis, kind of look at the headlines on Zero Hedge or wherever it is that you get your news, and then glance at the financial markets, take a quick look at a couple of things and go, oh, wow, that's what's going on today. Because that's what I do now. But I sat here for 15 years going, what in the holy hell is going on here? Eventually, you just internalize it all. Now, of course, you get to say to yourself, dude, that's what I pay you for. Well, fair enough. But, I like having disciples. It's fun. You know what I mean? I like having people to talk to about this. I don't know. It's good stuff. And I think that there's, we're all here at a certain level because we're worried about what to do with our money. Right. And if that's the case, then you really can gain a lot in terms of how to manage your money and how to manage your personal portfolio. And, my goal is to teach you how to fish as opposed to just giving you fish. Because if I teach you how to fish, well, you eat for a lifetime, right? And you can pass it on to other people. And then you can go, dude, I've had tremendous success with this. And then I get free advertising through word of mouth because it's the best form of advertising there is, and everybody wins, right? All right, moving on. So I've been making this point about gasoline prices. I'm not saying I'm the only one doing it, but I really want to show everybody just how tightly controlled the current round of inflation is vis-a-vis gasoline prices. So this is gasoline futures plotted against trailing 6-month inflation. Not yearly inflation, which everybody wants to talk about, but 6 months, because the yearly data doesn't make any sense. What I'm saying is, and the reason I chose 6 months was, one, because the data fit really well, but it also makes sense that this is how long it takes for a rise in gasoline prices to start showing up in the inflation data. It takes about 6 months. Not, overall, it takes about 6 months for the peak and the roll off. And so, in effect, what I was trying to do was show that, originally when I was putting this chart together, I said, well, if you just take the CPI the month over month change in the CPI and plot it versus gasoline futures 6 months out of phase with each other, it should line up. And it does line up pretty well. I think this is a better way of looking at it. Basically, the rolling 6 month inflation average or increase in the CPI, at least right now, is absolutely tied to the price of gasoline. And here's your impulse for this month. And here's what we're seeing in gasoline prices. So this is going to start rising rapidly along with a rise in gasoline. Okay. Now, if wholesale prices of gasoline don't get above $3 in the next month or two, if it gets to $3 and then tops out, then inflation is probably going to top out, and then credit effects and credit deflation will start to overwhelm the contribution into the CPI again. So, but this is magic right now. Especially what it's clearly showing you is that we have, especially starting in around 2019, commodity cost push inflation. And then once we're into COVID, clearly this correlation. But when we have demand pull inflation, these may not correlate. Okay. Under these conditions, they're correlating just nicely. This correlation will eventually run its course, right? Not every correlation, is set in stone all the time. This is part of the problem I have with, the price of gold it correlates nicely with the 3-year forward yield or this or that. All these bromides about the way markets work, and I'm like, no. They only work for as long as the policy regime is consistent. Once the policy regime changes, the correlations change, which is my point about what I was trying to, which is the period I was putting on the point I was trying to make during the opening remarks about the Bank of Japan and Ueda. The Bank of Japan is now moving towards establishing credibility again with the markets in a way that they haven't for 30 years. And none of us have traded or analyzed markets in an environment where both the Fed and the BOJ are trying to create credibility for themselves and accrete credibility to themselves. We have never, and not in my lifetime, not in my adult lifetime. And so it's gonna catch. I think it's going to catch certain people flat-footed and on the wrong side of very important trades. And they're going to be confused. I just do. I think it's important. So I may be wrong, and if I'm wrong, I'm wrong. But I don't think I am. Because if I did think, if I thought I was wrong, I wouldn't, if I thought that thesis was wrong, I wouldn't present it. I wouldn't have it, So I'm presenting it. I'm throwing down a little gauntlet here. We'll see what happens. All right, let's get started with the patron request hour. And I think I forgot to animate both of these. I did. Doesn't really matter. We're going to go through these quick. I have a tremendous backlog now. Y'all have sent in a ton of requests. I think my list is like 16 stock long. So bear with as we clear the backlog. I may have to do a midweek like morning munchings this week and just go through a couple of these with some short write-ups and a slide deck for you. as opposed to coming up the market reports with everything. So Garmin, and I've also changed the format so that the ticker symbols are right there in the slide deck now. So Garmin, very clearly we have a resistance at 105. That resistance stretches all the way back to COVID, pump, dump, back. I don't know anything about the company. I briefly looked at the financials. We got earnings this week. I saw that there hasn't been a whole lot of earnings growth, which is why over the past 2 quarters, which is why the price got up into the 100 range and it's kind of stopped. It's trading at a 2.8% yield. It's going to have to impress the market for a breakout here. But note, the sellers are mostly gone. Like, the stock wants to break higher here. But if it doesn't break higher and Garmin's business deteriorates at all, the market's going to punish it. Okay? And it's going to punish it in a way that will feel unfair. And the reason is that we're just at a moment here where the market positioning could just be incredibly short and just take the market down. I don't think that's what's going to happen. I think that if they come out with earnings this week that are even remotely good, we'll see a bunch of shorts flip and go on. But because this is clearly under accumulation. Okay? In 2023. All right. CleanSpark. There was a breakout here, and this is a weekly chart because I had to dial in. There was a breakout here, and we wound up with running into resistance and the 2-bar reversal so far this last week. Like, this is a close below that low. I looked at the numbers carefully. The low here was 612. We closed at 596. This is a 2-bar reversal. What I would say is that most likely coming into earnings, there's going to be a retest of the breakout area at 520. And then if everything's good, you'll see the market go higher. This is one of those things where, so it bottomed in April. We got a breakout, traded sideways, breakout. And now this consolidation area has to be, the top of this consolidation area has to be retested. This is kind of classic technical analysis. Again, don't know a thing about the company, didn't go into its balance sheet or anything else. I will only do that, FYI, if the stock intrigues me. Okay? I'm not going to sit and do a 30-minute bespoke chart reading because you're overweight the stock. I can't do that. That I can't do. Okay? I may do it. I reserve the right to say no to doing that. So any coverage on this stuff as we go along here. And to remind people, I cannot give you individual financial advice. I can talk to the community, but I can't really talk one-on-one like that. I don't have a Series 6, I don't have a Series 7. I'm not allowed. I'm not a financial advisor. I'm just a dude with an attitude and an opinion. It may be an opinion you respect, but it's still an opinion. And there are legal limits to what I am allowed to say and allowed to do. So if I do not answer your questions or your thing completely, understand that it's because I can't. Okay? If I address it in the market reports, I'll do my best. All right. Where I'm talking to the community. All right. And I know there's a lot of anxiety about, you all have positions and, I get comments all the time from people who have legacy stocks that they inherited or, they're all sorts of things and you don't know what to do with them. And I feel for you and, reaching out to me to hope that I can give you some guidance on this, but at the end is I get it. And, if I were in that position, if I were in your position, I would feel froggy and take the leap as well. Right. But at the same time, I need to clear the air that there's certain things I can't do. Okay. And at that point, I can't hold your hand through because I'm not allowed. Okay. And it's still ultimately your decision. My goal here is to teach you how to fish in such a way that you can make that decision and eventually not need me to help you do that. Or you keep me around to confirm what you already think you see, which is really what you want to do, which is really how you mostly want to use me. Right? Like, it's basically, I'm the second opinion that you have, that maybe you talk to your financial advisor or maybe you talk to your broker and he told you one thing. Now, let me talk to Tom and see what he has to say, blah, 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 blah. Right? It's the second opinion. And if you use me as a second opinion, it can be pretty powerful. And they may only do a technical read. And then you're going to have to marry that with what you know about the company or whatever. Okay. MicroStrategy. I find like uranium companies, I've complained about this in the past. Like, okay, so I covered Uranium Corp last week, and then I'm going to cover Cameco for somebody else the next week, and then I'm going to cover Denison Mines for somebody else the next week. I'm like, really? Can't we just look at uranium futures and make a decision about what we think about uranium? But I exhaustively had to go through like the top 5 uranium companies, in the American markets. I'm like, I don't see the point, right? I don't, frankly, because it's such a thin market. It's such a small market. It doesn't matter. Well, it's the same thing with Bitcoin companies. And we've now done a few of these, MicroStrategies, a couple of mining companies, blah, 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 blah. It's the same thing. They are completely and utterly tied in almost a 1-to-1 basis in terms of leverage. Especially MicroStrategies, because it's like their entire freaking balance sheet. And it's not like he owns, he's not right. Saylor's just buying Bitcoin. So it's going to look like Bitcoin. It's like looking at the Grayscale Bitcoin ETF. I mean, unless you are worried that, that's actually a more interesting conversation than MicroStrategy says, because, that's trading consistently below net asset value because it's a closed-end fund and it has the imperatives of a closed-end fund, versus market sentiment and net asset value. That becomes a very interesting conversation. MicroStrategy is like a uranium company at this point. It's just a Bitcoin company. Like, if you're bullish Bitcoin and you don't want to put your money on Coinbase, well, great, buy some MicroStrategies or buy a mining company. Like we did Riot the other day. The point that now the mining companies are interesting because depending on their co-location and their business model and everything else, they may have a little bit of leverage relative to the Bitcoin price, kind of like all-in sustaining cash costs in a gold mining company that are well below market value. Well, that's going to give you a tremendous amount of leverage once they're able to fully take advantage of that, right? And you'll get 2, 3, you may get, earnings blowing out 2, 3, 4, 5 times a commensurate price in gold. So you get a 20% move in the price of gold, you may see the stock may triple or double or triple or quadruple or quintuple. Why? Because at $1,900 gold, they've got, they're making 20 cents a share, but at 25, but at 20% above that would be what? No, $2,400, $2,300, but at $2,300 gold, they're making $1.50 a share. So yeah, their earnings expanded by 7x, so their stock price should expand by 7x. But gold only went up by 20%, right? This is why people buy mining companies. So in a sense, what you should be looking for in Bitcoin miners is the same kind of margin sensitivity. Can you find those outsized, opportunities where the beta for the stock is higher than, the beta of the stock is greater than 1, but not against the S&P 500, which is how beta is normally calculated, but against the underlying asset, uranium. So do a sensitivity, or in this case, Bitcoin or uranium or whatever, or gold. And that way you're going to find out which stocks have the best leverage and which ones you should probably buy, right? Or at least take a speculative flyer on. Okay, last thing to talk about is Trump's SPAC for Truth Social. I guess that's what this is, Digital World Acquisition Corp. And I'm sure somebody asked me about this. The person who asked me about this put it on the list like 3 or 4 weeks ago, and I hadn't got a chance to get around to it. Maybe 2 or 3 weeks ago, I hadn't had a chance to get around to it. Similar situation to Ripple a couple of weeks ago. Big SEC lawsuit against the company, or against it. Same as Ripple. And I'm sure somebody wanted me to talk about whether or not they thought the SEC case was any good. I wasn't going to talk about that. I'm just not interested in it. I'm just not. But the reality is I guess maybe I could have said something earlier than that. Maybe that's not fair. What I'll say is this. What's really clear, having read, a little bit this morning and kind of trying to cover this before I put the chart up, to get some background on this, is clearly this is not about earnings or the story here is not about earnings or internal rate of return, or debt to equity ratio, or goodwill and intangibles on the balance sheet, or free cash flow yield, or any of that stuff. This is about an SEC lawsuit, and what I think is similar to the Ripple lawsuit, that it was a politicized decision by the SEC. I think different circumstances. Ripple is really convoluted and murky and gets into the plumbing of the global financial system. This is really simple. They weaponized the SEC against Donald Trump, and the judge gave them the ruling they wanted. Oh, DWAC was in violation of some SEC rules, and then gave him a slap on the wrist for $18 million, which is nothing. And the stock popped 35 or 40%. Now, a lot of people were betting on that. Is it going to follow through from here? I have no idea. Watch it carefully, and I would be watching the weekly chart. Actually, right now you have to watch the daily chart, and once all the volatility subsides to see where the bottom comes in, then you can start doing some. I would be honest with you, this is where I wouldn't even use my own system. I would start looking at like Fibonacci series and stuff, because that's what's going to be dominating the way people are trading. Okay, because this is such a thin and weird thing. I would actually be. It's the same thing with Ripple. I actually caught myself the other day analyzing Ripple with some Fibonacci series and retracement stuff, which I never do, because it was such an anomalous event. Like my kind of technical analysis doesn't give you any clues. It just doesn't. It's an inadequate tool for that moment in time. My system my way of doing this is a trend following system, right? So I wouldn't say it's similar in idea to what Alex Craner does, but we use different tools and we have different methodologies, but our strategy is basically the same thing. We follow things from a trend perspective, and we use time to tell us what the real story is, right? When you have a spasm like this thing, where some extreme piece of policy, or it's a gold company that, you're waiting. It's the same thing for a gold company. When you're waiting for a news event to take a stock that's been beaten down for, 30 weeks, right? There's absolutely no way a trend following system will give you any reasonable information during the spasm as to how the spasm is going to resolve itself. Then you really have to go back to, okay, well, you should really use some more normal tools. And the reason is because now you're trying to figure out what everybody else is doing. So in this case, again, like I said, I'd pull a Fibonacci series off of this bar, off of this setup here, digging into the daily charts, and then run a Fibonacci series on it or something, right? Go look at the 22, 55, 144, and 288 4-hour moving averages. I mean, I'm dead serious. Like, that's what I would do. Or 4-hour daily averages. That's what I would do. Like, there's certain tools that I don't talk about anymore because I try to keep this, the presentation here, it's already complex enough, as simple as possible to teach everybody how to do, basic technical analysis, or what I think is, robust, if simple technical analysis. But I know how to do all the other stuff. And every once in a while, I will use them, but I don't talk about them. Okay. Here in the market reports. But it would be for a moment like this that I actually would. All right. So there we are. Moving on. Yes, we're almost done. Let's get out of here. So I presented the yield spread chart yesterday in the morning munchings. I was very encouraged by what I saw in response to the Bank of Japan. The markets went ballistic on the announcement in the overnight markets, and then everything kind of settled in. Dow was up for the day. Stocks were up for the day. The yield curve, the short end of the curve is a little messy, but this is the key. This is what you wanted to see. All of this in here. These tightening of these inversions, okay, is important. This is what we want to see. And then, the 1030 spread at this point is just going to be what it is. It's going to meander around. I'm not reading too much into this because what needs to repair itself is from 6 months to 3 years, because that's when the recession is being forecast. Okay. Now, I was asked directly this morning by someone to go over the U.S. German yield spread as I have presented them, and he was very confused. And I know why he was very confused, and I'm going to go over this. I'm going to go over this now in order to alleviate that confusion. This spread is from subtracting the U.S. yield from the German yield, right? So, subtracting the German yield from the U.S. yield. So, if it tightens, it's because the German yield is less than the American yield. So as it tightens, it means that whatever is happening in the general market is happening less for Germany than it is for the United States. So if we're getting selling, meaning then the U.S. yield is rising more slowly than the German yield is, because for example, if the spread here is on the 10-year is 1.8%. So let's just say for shits and giggles, if this was 4% on the U.S. 10-year, that would imply at 1.8% spread a 2.2% yield on the German 10-year, right? So now let's just assume that the yield curve didn't move at all and we get to here, and then the spread drops to 1.5. That means that the ceteris paribus, the U.S. 10-year is still trading at 4%, but the German yield is trading at 2.5%. It's rising relative to this. As the German bond market falls off a cliff, what's going to happen is you're going to get an inversion where this whole chart will go negative, because the American yields will be lower than German yields. Right now, German yields are still lower than American yields. And so until that inversion takes place, where it should be, which is that German yields should be fucking higher than American yields, because Germany's deindustrializing with an industrial PMI of 42 and 6.5% inflation, and I can do this all day long. And they're an energy importer, and they're having and they can't even get enough freaking gas. And Robert Habeck, the energy minister and vice chancellor, is out there saying it's going to be a tough few years as we transition over to our green utopia. Like, okay. And the United States is burning more oil than we ever have. And we produce it all. If we didn't have, President Poopy Pants in power and a bunch of friggin' crazy neocons, this shit would already be happening. We'd already be seeing German yields at 6%, American yield, German 10-year 6%, American 10-year 4.5% or even 5%. And this chart would be showing a U.S. German yield spread of -1 under that scenario. So as this tightens, German debt is either being sold faster or bought slower than American debt is of the same duration. I have the 2 and the 10. But that's what happens when it tightens. When it widens, it's being sold slower or bought more aggressively than the U.S. spread. That should now make complete sense to everyone. Okay? And when it tightens, it means that Germany is losing confidence in the American, relative to American market. In traders' minds, Germany is losing the battle of confidence of bond traders faster than they are of American markets if the yield curves are rising, right? If the yield is rising, and vice versa. So it's a little convoluted, but actually it's really simple. Tightening means bad Germany, means bad news for Germany. Widening means quote unquote good news for Germany. So the question then is, since we've been in this bull market for German spread, and the fact is that as the yield widens, right? As the yield widens out, which is what we've had since Ueda first came in back in the end of April and said, we're still here underneath the market. We've seen the yield spreads on both the 2-year and the 10-year blow out higher. Lagarde has been able to hold her lines in the sand in place. German 10-year still trading below 2.5%. The American 10-year's threatening 4% again. So we're near back to 1.5%, or just under it. But Ueda just changed Japanese policy. So is this going to roll over? It should. And given what we've seen in the 2-year market and how disorderly it can get, we should probably expect the 2-year yield spread to do the thing far more than the 10-year. Meaning we should expect higher volatility in the 2-year spread versus the 10-year spread. Certainly at this point in time, if everybody's forecasting recessions and, yada, yada, yada. Which then gets back into, can Lagarde afford to even raise rates from here? Because she can't continue to afford the euro at $1.10. But the reason she's got the euro at $1.10 is because oil prices have been low. They've been trying to keep energy costs under control, to tame inflation, to refill the gas storage and all the rest of this. Play the energy game before winter. And then when the numbers start shooting up this winter and they're buying energy and oil's at $95 or $100 a barrel, because at this point, like, Putin has made it abundantly clear that he's really done with Europe. He's more done with Europe than he is the United States. And he should be. Because Europe is his neighbor. It's clear that the United States is a global power in retrograde. Okay? So, and inflation's coming all the way across the board. Copper, $3.93 a pound. The U.S. dollar index has bottomed and moved back towards 102. Again, I don't know if Francis Hunt's going to be right on his call to 97. Ueda just loosened the Bank of Japan's put underneath the market. Was that expected? I don't think it was expected this month. And I don't expect the euro to rally to $1.14 here. And if it does, you're just putting Lagarde even tighter in the box. Because then eventually she's going to have to let the yields go. Because who's buying the sovereign debt other than the ECB? All right. I don't know. But there you go. All right. And then the Dow. So we had the big breakout from the consolidation pattern in the Dow last week. We got follow through, higher high, very, very low volatility, where these two numbers summed to 145%, which is a very low volatility on the weekly chart in the Dow. So now, when I forgot to animate that, now we bring in the monthly chart. Oh, look, what do we have? We have a breakout on the monthly chart from consolidation. So this becomes this, and that, and this becomes that, and there we are. And everybody's going to get it wrong. And so if we close, and then we're projecting for next month that we're going to have a very strong probability, nearly 100%, of going higher versus going lower and getting follow-through action. And I would be surprised if we don't retest the 2021 highs, which are only 2,000 points away. I'm not saying we're going to do it next month, but it's possible because the range on the Dow is 1,600 points every month. But you should expect a little bit of a retest here of the breakout area, the top, this 34.7, 34.8 area, before making a move, a proper move towards 37. Okay? That's what I would suggest. All right, so that's what I've got for you today. I hope a lot of that was clear, and that helped clear up some misconceptions about things and all the rest of it. All right, so sounds good. Why don't we call that a day? You guys be well. You take care. We'll talk soon. Talk Wednesday. Keep your stick on the ice.